Okay, so we are live with the next session, Deconstructing DeFi, what to know about the future of finance. We have 4 experts here. Very, very glad to welcome the 4 of you. You saw Patrick yesterday from Crypto Finance on our opening panel. He's back. Welcome. We have Francisco from BBVA. Welcome. You were with us in last edition. Lex from ConsenSys. You've also been in one of our previous editions. Welcome. And Stephen, welcome from Fireblocks. Your CEO was with us yesterday and great to have you today. So the stage is yours, Lex. I'm going to give you the microphone.
Awesome. Thank you so much. And welcome everybody to the session. We are going to talk about decentralized finance, finance that has been atomized, decentralized, tokenized, open sourced, and made available for all of us to enter the next stage of fintech infrastructure together. I'm Lex. I'm the head economist at a firm called ConsenSys. We're behind MetaMask and Infura, and I'm excited to have this panel. We'll do introductions in just a second. We've got about 45 minutes, 40 minutes to go. We'll leave about 10 minutes for questions. And first, we'll get our definitions down and open up these topics. So with that, maybe Patrick, Francisco, Stephen, if you could do a little bit of an introduction on you and your firm, and then we'll hop into the questions.
Sure. I'm glad to be again on one of these panels. It's always quite refreshing to speak to other people and hear their opinions. My background is interest rate derivatives trading. I worked for almost 20 years for a large investment bank, and then I sort of tumbled into the crypto rabbit hole. I'm now 4 years at Crypto Finance, which is a company that does brokerage, asset management, and as well storage, so wallet solutions for the crypto trading business. And I'm the head of trading at Crypto Finance Brokerage AG.
Fantastic.
Hello, everyone. So I'm glad to be back here in European Blockchain Convention and looking forward to next year to see if we can see each other in presence and not virtually. But for this year, this is what we have. I'm very happy to be in this panel and to talk about DeFi. My background is similar to Patrick's, nearly 20 years of experience in banking, in different positions around the bank, operations, technology, corporate and investment banking. And since 4 or 5 years ago, I am leading the blockchain efforts within BBVA, defining the strategy and executing the different programs and projects that we have within the bank.
Great. And my name is Stephen Richardson. I'm based out of Singapore. I work with Fireblocks. We're a secure digital asset infrastructure company. I head our business for APAC as well as lead our product strategy and business solutions teams at Fireblocks. My background is I come from strategy consulting, working with financial services institutions as they engage in innovation and digital within the financial services space for a number of years. And then I jumped into the digital asset space, working for a startup in 2016, and have been in the digital asset space ever since, now with Fireblocks for the last 2+ years. So very excited to talk about DeFi and to be on the panel with everyone today.
Awesome. So as you can tell, people have a combination of an institutional background and kind of being engaged in the crypto ecosystem. It's tough to do virtually. This we're all in the Zoom metaverse wonderland, but it's always fun to get a sense for how deep in the rabbit hole people are. So I'm going to do a quiz. It's a pop quiz, surprise quiz. First off, raise your hand if you have ever transacted in Bitcoin. Okay, we're good so far. How about some computational blockchains? Anybody got Ethereum or Solana or they're getting me. Okay. All right. Now we're gonna go a little bit deeper. We're gonna go into, have you ever made a trade on Uniswap? or on Aave? Okay. Oh, okay. Let's see. Collateralized stablecoin borrowing. Okay. Okay. So where else can we go? How about put assets into a layer 2 bridge to transfer them into a different protocol? All right, there we go. Okay, so we do have a panel of folks deep in the rabbit hole, and so let's switch to the rabbit hole, which is decentralized finance. A little bit of a salad in terms of the words, but there's the word decentralized, and then there's the word of finance. I'd love to just open up what those words mean and why they even matter. And so, Patrick, maybe we can start with you to just kind of flesh out what DeFi does and what it is.
Sure. First, I would like to say that I think the terms DeFi are getting misused quite a bit sometimes, or the perception of people is quite different what DeFi actually is. For me, DeFi is that I can access a protocol permissionless and I can do it trustless. So I don't need to know with who I trade or who is on the other side of it. But then I just want to throw that into the ring. How much decentralized is the finance protocol if I use a stablecoin that is centrally backed, like USDC? Or if I bridge my tokens from one ecosystem to the other and the bridge is centralized. So how DeFi is that? I just want to throw that in, but my first statement is clear. It's trustless and permissionless.
Question, I guess, to building on that for Stephen around the primitives, the components within DeFi market infrastructure. Like, what are the types of things, the types of machines or businesses or asset classes that, you know, one could access on this sometimes centralized, sometimes decentralized financial infrastructure?
Yeah, look, I think the mechanism is to recreate a lot of centralized services that we see in the space today. So where they be trade and execution basis off of a DEX, or they be lending and borrowing infrastructure, or yield generation. We're seeing the development of protocols that allow that in Patrick's terms, a decentralized mechanism, right? So the ability to access it at a permissionless level and do it without necessarily the concern around who's on the other side. So, you know, I think the main mechanism is a replication of functionality that generally has been centralized. In order to access those services before in the space, you had to go to different institutions, whether they be folks like Genesis and Galaxy and Crypto Finance and others, or you had to go onto centralized exchanges, right? And the points of access into those systems sometimes could be burdensome for folks. And sometimes inefficient, right? And so what you're seeing now is this kind of layer or kind of technology application layer that enables, in effect, an efficiency play and a kind of an open access play to all these different services, and allows people kind of this open level or same level of access if they're able to utilize technology to access it. So you know, that's the broader premise in my mind.
So in crypto, we have so many words and they're all so magical. And I want to slow us down a little bit and just open up the words. What is a DEX? What is a stable coin? What is an AMM? Assume those are mysterious voodoo language words that aliens shoot out of their eyes. And let's try to explain it to people from scratch.
So I may start with this one, and it's not easy because it's bringing something very complex to you know, a very simple way of explaining it. But I would say that DeFi is a different way of doing things, as Stephen was introducing. One relevant thing is that we are now operating peer-to-peer or peer-to-institution. We are operating peer-to-contract. Okay, so this is one of the first changes that we see in this ecosystem. We are operating against a smart contract that has assets, okay? And you're exchanging your assets against the assets of this smart contract. This is what's called a liquidity pool, okay? This is a smart contract, which is enabling this exchange of assets between you and the pool that it controls, is what we could call an automated market maker. So in the end, the price is set up by the amount of assets in that pool. Depending on the amount of assets on that pool, you have one price of the other. Okay, and this is totally automated. Okay, there is no intervention of humans or anyone in the process, just you against the contract. No? In these liquidity pools, normally you operate in pairs. And these pairs mainly are stablecoin against crypto. And this is where we introduce stablecoins. Stablecoins, we can see it as the oil that lubricates all the DeFi ecosystem. No? And stablecoin is nothing more than a token which has an underlying behind it. That it could be a US dollar, in the case of Tether or USDC, or it could be gold or any other kind of asset. So then we have other type of algorithmic stablecoins, but I won't go into that ones because the ones that we mainly use are the ones that have some real collateral behind it, such as dollars or euros. No? So we have stablecoins, we have contracts with liquidity pools, and then we need liquidity providers that are the persons that are able to provide liquidity to these pools. And in this case of DeFi, decentralized finance, as Patrick was introducing before, anyone can be a liquidity provider. In the traditional markets, we have big institutions that are the ones generated or creating the market by providing liquidity in the big market infrastructures. In this new market, you don't need, you may have them because we see, exchanges like Coinbase or others that may have excess of liquidity or that are willing to provide liquidity to DeFi. But anyone could be a liquidity provider and provide liquidity to these liquidity pools so that these smart contracts can offer trades to the users that operate within. And I don't know if I am making myself understood.
Yeah, no, you're doing great. Yeah, so
I will leave the rest of the panel built on top of this and try to bring it to a simplest way of explaining it.
No, that's great. And so I think Stephen helped us establish that it's the same things that finance always does, which is pay, save, trade, invest, and capital markets just kind of recreate these patterns, as well as the human behavior around value just gets recreated in different venues. We've got a computational blockchain which is validated peer-to-peer and hosts information in a peer-to-peer manner and is quote unquote trustless and permissionless, which allows one to feel confidence about the data that you're interacting with because of lots of math. And so on this infrastructure, we've started talking about some of these primitives. So we've talked about the stable coin, which is like a crypto dollar. It's a cash equivalent. People should be familiar with what a money market fund is. So there's various shapes of cash sweeps and crypto dollars and so on. A very familiar animal. And that's the stable coin, and it has both the payment and the capital markets utility. And then you've described the automated market maker, which is like, hey, there's Citadel, they do some market making, 6 billion per quarter worth of revenue of market making, but give or take. And then there's market makers on this network, on this blockchain network. And because we're in early days, they're much more compressed. They're really pixelated and sort of janky, but very interesting and performant and have billions of assets in them. And that allows people to become market makers for particular trading pairs. Let's do one more maybe as to establish a little bit more around this one to Patrick. Can you talk about some of the lending markets, things like Compound and Aave, and if we want to get sort of more hairy than that with Maker and stuff we can, but there's lots of interest rates. If you come to crypto, you get 20% interest rates. What is the interest rate? What is the lending market? How does that work?
Sure. Well, first of all, the decentralized finance markets are very hard for me as a regulated entity to access. But Compound and even Aave, they have, or they try to make versions where the institutional players can actually access it, where you have permission pools or you have guardians that make sure that the wallets that interact within that permissioned version of the DeFi market is are allowed to do so. Coming back again to this is not really DeFi then, because it's actually permissioned and people have to people know who it is and they have to follow certain rules. But you mentioned interest rates, and especially for clients on our end where they're token holders, they're long these tokens, and at the moment they just pay something to store them safely with us. They would love to get some interest on their holdings. And this is where Aave and Compound, as one of the two oldest and largest protocols on the borrowing and lending side, would come in handy if I can actually connect with them and put clients' money at work on these protocols. Maybe also regarding interest rates, there is always the question popping up by quite a few of our clients and investors: why is the dollar interest rate so much higher in crypto than in the traditional world? And there is no clear or probably satisfying answer I can give them, but mostly it is because the crypto trading ecosystem is still very much in need of these on and off ramps for fiat. And it's still not that easy to move money in and out. Some of the larger banks are blocking these payments, or you have certain rules how much money you can move up or down. And this basically creates a bit of a dollar shortage within the system. Hence, the dollar rate is always a bit higher than in the traditional market. And this is also something which could be highly profitable or interesting for clients that do not own Bitcoins or Ethereum, but they own USDC, for example, and they can lend it out to very favorable rates. So these protocols are actually showing real added value to the investment or investor base that is brave enough to move capital into the space.
Interesting framing. I agree with a lot of it. I think one mental shortcut is just to say it's a big margin desk. You bring a thing, somebody wants to borrow it, they pay you interest. And so these money markets are kind of equilibrating supply and demand for going long or going short. So again, something very familiar for anybody that has worked around a trading desk. So I wanted to kind of establish that we have these primitives which are configured differently because they're much more automated, but are doing things that we should be familiar with from financial services. And so we touched on this already a little bit, but I wanted to talk about the challenges of getting like exposure, of getting connection into these assets. Like, why is it hard? Who bothers to stop me? Who creates the challenges? It's 2021. Why is it still, well, it's almost 2022. Why is it still sort of a problem? Stephen, could we give you that question to pull apart?
Yeah, not a problem. So I think there are two components to look at, right? The first is the technological, right? So the idea of creating wallet infrastructure and secure access for getting into DeFi, right? There's a lot of risk that comes with allocation of funds, right? And generally, those risks are in some ways mitigated against centralized institutions, right? You're able to evaluate counterparty risk of exchanges like Coinbase and Kraken and Bitstamp and, you know, a whole host of other ones, and assess, you know, the risk that you take against putting your funds on those different exchanges. And you're able to really manage how funds go into those exchanges and all the different components. When you look at DeFi, right, you're looking at the basis of allocating funds against sets of contract calls, and the governance mechanism that you can have against those at points in time tends to be limited. So you have folks like MetaMask Institutional that have developed solutions around that. We have Fireblocks as an infrastructure provider are doing quite a bit to, you know, link the governance models that folks can use against the wallets that they deploy these assets to against, you know, the different DeFi applications, right? There's that piece. I think the second one that Patrick mentioned is regulation, right? I'm a large institution. I have lots of capital at my disposal, but I can't really enter or participate in a market where I don't know who is on the other side in terms of receiving those assets. Do I know if it's terrorist financing? Do I know if it's illicit gambling? I have no real idea, right? And so obviously, you know, Fireblocks is involved with Aave Arc, which is this permission DeFi pool, right? But, you know, the basis is to solve some of those problems in terms of enabling the utilization of the technology from an application perspective, but ring fencing some of the risks that occurs, right? So I think those are the two big risks like that I see in terms of entering that. I'll give you just an example. I mean, I used a second layer bridge to move some funds across, and the first time I did it, my money got stuck, right? So, and I work in crypto, and so I think there's obviously, you know, the ease of use, you know, understanding what the different applications are, understanding, you know, what it means to switch from one set of wallets or technology stack to another, right? And then being and familiarizing yourself with that, right? And I think there are a lot of different technology applications that are looking to simplify that process, you know, Fireblocks included. And you know, once you kind of solve that issue, right, then I think the next becomes like the regulatory and governance perspective that needs to be solved. And I think, you know, folks like Aave and Compound and others are making a pretty active attempt at being able to do that, to then broaden the ecosystem, right? It doesn't, you know, just because someone is participating in a permission pool does not mean that they won't just turn around and leverage, you know, permissionless pools, right? So there's still this mechanism by which liquidity kind of makes itself available in the whole ecosystem, and we think, you know, creating different avenues for folks to be able to access that is important.
From the perspective of from a banking perspective, or like a large institutional perspective, you know where this is going. You know, question about BBVA and the asset class more broadly. You know, one thing to kind of note is that over the last 3-4 years, there's been all this attention around blockchain software, and banks have gotten around being comfortable with tokenizing and integrating blockchain software and designing a cash leg in this experiment, and it's roped off and it's permission, blah, blah, blah. But here we're talking about an asset class that is, you know, 2 to 3 trillion, depending on the day, and live, and doesn't really care about the comfort that banks have or don't have. You know, it exists and it transacts. And so I guess the question, Francisco, is how do you see the bank or banks more generally taking steps on the revenue generation side of the business, saying this is an asset class that we see us distributing, that we see us providing to our customers, and like, what's the path there?
Okay, so well, it depends on the entity, and of course we always have to take into account regulation, as Patrick and Stephen have been mentioning. But you can see it as a challenge or as an opportunity, and we in BBVA see it as an opportunity, and we want to be in that new market, and in both ways. So we want to leverage on the technology and then use it as the new rails, as you were mentioning, for tokenizing cash, tokenizing financial assets. But we also see it as a new market where we want to provide access to our customers to this new market in an easy way, in a simple way, in a secure way, and removing all the complexities that Stephen was mentioning just before this question. What we have been doing, we have been starting by providing access to trading and custody of Bitcoin and ETH from our BBVA Switzerland branch or bank. And our private banking customers can now buy, sell, and custody Bitcoin and ETH with us. So we have initiated the journey by providing trading and custody services to our customers. Once we have initiated this journey, we are now looking towards the possibility of expanding the offer of tokens. So now we have Bitcoin and ETH, but we want to have more, not only security tokens, but also other cryptocurrencies that we can be compliant with regulation and have in our offering. And we are starting to see in what geographies of our footprint we can offer these services. So not only from BBVA Switzerland, but also from other banks in the group. That's the journey we are following. And of course, when we have started with trading and custody, once we have the custody, the next step, the next frontier would be providing yield. And this could be through DeFi, but we see DeFi further away. We are starting to work with trading and custody. And as soon as we can start operating securely and in a compliant way, we will try to get involved in DeFi, and maybe through partners like Steven or Patrick that can help us bridge and access that new world and offer the service to our customers.
Awesome, thank you. I think there's also a framing potentially around, like portfolios and asset allocations of. It's like, yes, there's access to trading, but there's also like a place for this thing, and from an institutional perspective, I think there's a lot of value.
That's true, Lex, and I forgot to mention it. I was talking about direct access to crypto. The other leg would be indirect access, and we are also working in that space with our asset management team in enabling our customers to access, NDFs or other derivatives options and direct exposure to crypto. And this is another way that we are exploring, and that's easier from a compliance regulatory perspective.
Yeah, absolutely. So, Patrick, I think we've got just this one last question before we go to audience. Double clicking on the asset management point. How do you think about first, maybe if you could tell us about what options are there for DeFi connected asset management, right? You got Yearn on the one side, and then you got ETFs of futures, and there's all this confusing nonsense out there. So like, what is on the menu for asset management, and then for your business and the things that you do, how do you make decisions to move forward that operationally?
It's a twofold question, because from our company side to basically answer it is, since I cannot interact with any of the DeFi protocols, so I cannot use Yearn Finance or I cannot use the Melon protocol to deploy assets in different vaults that are generating yield. What I can offer, or what we, our asset management, can offer is, for example, a fund that has a set of different tokens that is, and I always say it's basically the full menu of DeFi. So you have some tokens in there that earn yields, which is Yearn Finance, Aave, Compound, but you also have tokens in there that are decentralized exchanges like Uniswap or SushiSwap, where they generate cash flows and the token should get some revenues back on these cash flows. Then we also have infrastructure tokens, because the DeFi system cannot live without oracles, for example, or graph indexing. And all these, I call them service providers to the DeFi industry. They make a good mix in a DeFi fund. If you talk about me as a private investor, when I move around capital in the DeFi sector, I think and that's the real cool thing. The possibilities are almost limitless. I can do so many things and put different strategies together, monitor them, or move the capital very swiftly around if somewhere is a better yield opportunity. It's something I struggle to explain even to my former trading colleagues that are not in crypto. It's very hard to grasp, and the speed of it, to how it changes. But again, there are a few platforms that offer that combination, and they call them vaults, where you just put capital into a strategy, and there is a very complex code behind that is basically managing your capital in there and is trying to earn a decent reward, which is pretty cool as well. So passive income made by DeFi.
Absolutely, and hopefully our audience is connecting the dots to Stephen's earlier point that, again, we're recreating a number of our industries in finance, except using architecture that is a lot more modern and also interoperable. So you can go from market making in the middle of a giant market venue to asset management to options trading to sort of as risk-free cash-based interest payments as you can get in crypto, within a series of 4 trades and without any barriers of any kind. And that is, it's unusual that the retail experience is so much easier than the institutional experience, because in the past, of course, the institutional experience was far more fully featured than the retail experience.
Yeah. I mean, I think there's one thing to kind of be aware, at least in my mind, around DeFi, right? Like you see this basis of like replication of traditional financial products in this decentralized way, right? And then this easing of use, right? It's this evolution that's occurring. I actually think the real thing that becomes interesting is like how when things like tokenized securities and other assets come into play, like how DeFi will impact those, right? Like I think we're seeing this continuous evolution. For example, I'll give the example in Germany, right? You have the crypto securities registry, right? That basically has changed the model to allow folks to not have to use a central securities depository for issuing securities in a crypto basis. Well, that becomes interesting because you can have anyone that's a regulated custodian theoretically tokenize an asset and allow it to be traded, right? Under a regulated basis, which then could lead to the utilization of things like DeFi applications and pools of liquidity for purchasing of these different things without central intermediaries, right? So I think there's these like graduated steps that DeFi is doing, right? That then become more applicable to more and more financial products. And I think that's the beauty of it all, right? Is like where that disruption will start to exist and what new markets that have been previously highly regulated will be impacted by this new technology and allow folks like Patrick and folks like Francisco and others to be able to leverage it in a more efficient model. So I think all of this is pretty interesting in terms of how it starts to shape up over the next few years, in my mind.
Absolutely. Thank you for that. Very eloquently put. We've got a couple of questions here in chat. There's a rug pull question and a token burning question. So we'll have a little bit of fun with these. Francisco, can I give you the rug pull question? How should we feel about DeFi when there's some anonymous team that can just take your money and defraud you and scam you? Like, what do you think about minimum standards of regulation, of behavior, of self-policing, and how does that trade off with the user experience? And in part, I'm asking this for you because in the banking world, it's almost the opposite way, where the user experience suffers so much because of the regulatory frameworks. Yeah,
so in the end, I think that DeFi is very new, so it's a maturing space, as was crypto maybe 5-6 years ago. That needs to evolve and improve and mature in every sense. So from the regulatory perspective, I think up to a point, regulation will appear. If not, institutional money will not enter the space, and it would be, and the risks underlying in DeFi will remain. No? So we see several risks, some of them mentioned in the question. No, we see technical risks, depending on the development team, they can do things correctly or not correctly, and there can be scams or even hacks on the protocol. And there are the risks of volatility, and this is mainly due to immature markets, no, with lots of risks, or have lots of volatility. Speculation is also around, and it's removing the interest from very interesting projects and proposals and value propositions, and it's introducing lots of noise in the industry. So there are several risks that these projects have, and there are ways of mitigating them. Of course, you have to be very careful of who are the development team of that protocol, who is backing that project, venture firms or institutions that are behind the developer team. How is the governance of that protocol defined, and who is able to make decisions or not? The amount of decentralization or not decentralization, as Patrick was introducing before. So there are several metrics that you have to evaluate before deciding getting your MetaMask and interacting with this type of protocols. No? You have to see that this is a reliable protocol with a great team, with a relevant venture capital behind, that has gone through security audits or code audits to make sure that the code is correct and that there's not going to be any problems, that it has enough liquidity so that you don't have very much slippage when operating. So there are several things that the gas price at that moment, I mean, it's a very, very complicated world. So if you are not very into it and understand very well the different risks, the impermanent loss, the different problems that you can have with the different protocols, it's better to rely on a third party that has that expertise and that can target you to validate it or audit it or reliable protocols where to operate or interact with. No?
Absolutely, and if I could just land the point, I think the end of the day, these are still human relationships and human markets. And I want to frame one of the questions here in chat that I think connect. And the question is, about distribution, about direct access. Like, what's the impact on underprivileged or unbanked populations? And then another question about, is the relationship to the machine or between borrowers and lenders? And to me, I sort of read this like, who am I transacting with question? And I'd love to just leave that question with you to discuss. I've got to hop off. It's been a pleasure. Go to metamask.io and download the crypto wallet. And then I think pondering the human nature of DeFi is a very interesting place for us to end. Thank you, everybody.
Thank you.
Thanks.
Go
ahead, Patrick.
Oh, sorry. I might just want to pick up again on that DeFi and regulatory question. This is one of the things I said at the beginning. They don't go together. So DeFi is unregulated and it will stay unregulated because regulation is centralized. So it's for me, it's a bit like you want all the rewards but no risks. And DeFi is just the unregulated space, and I really hope it will always be that way.
Yeah, look, I think to that question of direct access and all those other components, right? I think I look at DeFi maybe slightly different, right? As like the technological like advancement without general human intervention at its core, right? Maybe that's how I'm looking at it. And it's abstract and wrong, but I look at it and say, like, generally on a basis, you have centralized operations teams, you have all these components that are built in place that rely on human intervention, large scale institutions, right, in order to execute and run and function, right? I mean, every bank has massive operations teams, back office teams, reconciliation teams, et cetera, right? To me, DeFi is a basis of using a technology application to replicate and execute all those functions, right? Which inherently to me also means there's lower cost of service. There's ability to extend those services to different realms, right? To put them in institutional wallets, to connect WhatsApp wallets to different pools, right? So such that you have a stable coin where a person utilizing remitted funds can earn some level of yield through a validated protocol, right? and you're able to do it in a way that hopefully passes more value to a consumer, right? So I see it as a basis of being able to extend the financial ecosystem, right? And I see it as ability to disintermediate or disrupt a lot of, core, let's say, FMI infrastructure, right, that's been in place for a long time, right, that theoretically, in my mind, can be disrupted with the technology application, right? There's generally no need for that, I think, as more things become tokenized. So I maybe look at it not necessarily in terms of distribution of risk and the permissionless. I agree with that component. I think that's where innovation continues to occur. But I didn't think about it as like the disruption of operational processes that today exist in legacy systems and how those get moved and shifted over time.
I quite agree on that. Maybe to add to the point or the question Vincent is having regarding direct access means more banking available for the underprivileged. It always sounds good that crypto enables you to have, if you're underbanked, that you have better access to the finance sector, but there is still a bridge needed. So even if you have no bank account, so how do you move any of your capital into the crypto or DeFi world? So you need the help of WhatsApp or any other sort of social network system that is opening up a ramp for you. And even then, how do you get your money that is in your pocket right now up to WhatsApp or any social platform, up to the crypto, up into the crypto world? What it does do though is, if you have money in the system, in the crypto system, no one can tell you what to do with it. It's your responsibility, and you have all the options. None of the banks, and Francesco, you might add something to that, but none of the banks or banker will tell you, I'm sorry, you cannot buy this bond because you're not a US citizen or whatever. So then, yes, your privileges will be better than if you're just a normal retail banking customer.
But yes, just to finish, Patrick, following on that, you are free to do everything, but you need capabilities, and that capabilities means custody, means understanding, means having quite a good PC or mobile phone in order to do all the interactions with the smart contracts. So in the end, I think that it's not easy for this, and bank normally are people with very low resources to have the technology and the knowledge enough to be able to operate in this space. So I don't see it as so democratizing in that space. And also the gas fees you need to operate in DeFi are normally very high. So maybe it's not that suitable for underbanked.
Thank you, guys. Thank you, Steven. Thank you, Patrick. Thank you, Francisco. Thank you, Lex. Amazing panel discussion. Just one quick question. When will DeFi be? 5? What year? Patrick?
When will DeFi be what?
5. Just finance.
Just finance. I hope it will never happen. DeFi will stay DeFi.
Steven?
Personally, I see more adoption happening in the next 2 to 3 years, at least from what we're talking with institutions around.
2-3 years. Francisco?
Well, I don't have the answer, because we will see if the regulators want to start entering the space and looking for people accountable in the DeFi space, and maybe they kill it, I don't know. But if it continues to evolve, maybe 5-10 year time frame, and I hope that we are able to leverage all the new good stuff that it's appearing in the space and use it in the traditional finance world.
Thank you so much, guys. Fantastic. So thank you for this panel discussion. And for the audience, please go to the next session. We have a keynote with Jordan from Stellar Foundation. Thank you, guys. Bye-bye.
Thank you. Bye.
Thank you, guys. Bye.